In September 2008, when the Lehman Brothers collapsed and the entire global financial system was on the verge of total meltdown, I made $1.1 billion in a single month. While pension funds lost trillions, while banks went bankrupt, while ordinary investors watched their life savings evaporate, I was systematically profiting from the chaos. People called me ruthless. They said I was betting against America. But what they didn't understand is that the market crashes don't destroy wealth. They transfer it from the unprepared to the prepared, from those who panic to those who think clearly, from those who fight the tide to those who ride it. I've lived through 14 major market crashes in my 60-year career. The 1973 oil crisis, Black Monday in 1987, the Asian financial crisis of 1997, the dot-com collapse, the 2008 financial meltdown, and each time the same pattern repeats, the same mistakes, the same psychological traps, the same wealth destruction for most people. But for those who understand how crashes really work, for those who master the psychological and strategic principles that govern market panics, these moments become the greatest wealth-building opportunities of their lifetimes. Today, I want to share with you the 5 strategies that have allowed me to not just survive market crashes, but to profit enormously from them. Strategies that go against every instinct you have. Strategies that feel wrong when you need them most. Strategies that separate those who build generational wealth from those who lose everything. Because here's what most people never understand about market crashes. They're not random events. They follow predictable patterns. They create predictable opportunities. And if you know what to look for, you can position yourself to profit while everyone else is running for the exits. Strategy number 1, think in probabilities, not predictions. The biggest mistake investors make during market crashes is trying to predict exactly when they'll happen, how severe they'll be, and when they'll end. They desperately want certainty in an inherently uncertain world. This approach is not just wrong, it's financially catastrophic. Successful crash investing has nothing to do with accurate prediction and everything to do with probability assessment and positioning for multiple scenarios simultaneously. Let me tell you about my approach leading up to the 2008 financial crisis. I didn't predict that Lehman Brothers would collapse on September 15th, 2008. I didn't know that AIG would need a bailout. I couldn't have predicted the specific sequence of events that unfolded. What I did recognize, starting in 2006, was that certain structural conditions were developing that significantly increased the probability of a major systemic disruption. Housing prices had reached levels that were mathematically unsustainable relative to median incomes and historical trends. Financial institutions were employing leverage ratios of 30, 40, sometimes 50 to 1. Complex derivative instruments had created interconnected risks that nobody fully understood. And most importantly, I observed that market participants had become systematically complacent about these risks, pricing securities as if the probability of significant problems was essentially zero. This created what I call a fat tail opportunity, where small probabilities of extreme outcomes were being severely underestimated. I began positioning my portfolio not based on precise timing predictions, but based on asymmetric probability assessments. If I was wrong about timing or magnitude, my losses would be limited and manageable. But if I was generally correct, my gains would be enormous. This is probabilistic thinking. Instead of asking, when will the market crash, ask what is the probability of a crash occurring within various time frames, and how should I position myself to benefit from those probabilities. During the 18 months before 2008, I systematically built positions that would profit from declining asset prices, increasing volatility, and financial system stress. I bought credit default swaps on financial institutions. I shorted overvalued real estate investments. I allocated substantial capital to safe haven assets like treasury bonds and gold. Crucially, I structured these positions so that time decay and carrying costs wouldn't destroy me if the crisis took longer than expected. Many investors who correctly diagnosed problems in 2006 to 2007 lost money because they positioned too early or too aggressively. Probabilistic thinking also means understanding that crashes come in different forms. Sometimes you get sharp corrections like 1987, sometimes prolonged bear markets like 2000 to 2002, sometimes systemic crises like 2008. The key is positioning to profit from multiple scenarios rather than betting on one specific outcome. Here's how to implement this practically. Instead of trying to time crashes perfectly, assess current conditions for crash probability indicators. Are asset prices significantly above historical norms? Are investors displaying excessive optimism? Are institutions taking dangerous risks? If multiple indicators suggest elevated crash probability, begin positioning gradually, reduce exposure to overvalued assets, increase allocation to defensive investments, and cash. Consider protective strategies like put options, but size appropriately so carrying costs don't erode wealth. If timing is imperfect, think in terms of risk-reward asymmetry rather than precise predictions. Look for investments where maximum loss is limited, but potential gain is substantial if conditions develop favorably. Strategy number 2, embrace volatility as your greatest opportunity. Most investors treat volatility as their enemy. When markets swing wildly, their instinct is to reduce risk and wait for calm. This is completely backwards. Volatility isn't your enemy during market crashes, it's your greatest wealth-building opportunity. I learned this during the devastating 1973 to 1974 bear market. The Dow fell nearly 50% and many stocks declined 70 to 90%. Most investors were paralyzed by fear, either panic selling at terrible prices or freezing completely. But I recognized something crucial. Extreme volatility creates extreme mispricings. When fear dominates psychology, assets frequently trade far below intrinsic value. When panic spreads, excellent companies get sold off along with genuinely poor investments. This creates extraordinary opportunities for prepared contrarian investors. The key insight is understanding that volatility is not the same as risk. Volatility is the degree of price movement around an asset's intrinsic value. Risk is the permanent loss of capital. During crashes, volatility spikes dramatically, but this often creates opportunities to reduce actual risk by purchasing valuable assets at discounted prices. During 2008, shares of world-class companies like Johnson & Johnson, Procter & Gamble, and Berkshire Hathaway fell 30 to 40% along with everything else, despite having strong balance sheets and stable cash flows. This wasn't increased fundamental risk, it was opportunity disguised as volatility. I systematically took advantage by implementing volatility arbitrage. When excellent companies fell to obviously undervalued levels due to panic selling, I accumulated large positions. When fear-driven bounces pushed prices above fair value, I reduced exposure. The extreme swings that terrified others became my primary profit generator. Successfully embracing volatility requires specific preparation. First, you need sufficient liquidity to act when opportunities arise. During 2008, many sophisticated investors recognized attractive prices but couldn't take advantage because their capital was committed or they couldn't access financing. Second, you need predetermined criteria for identifying opportunities. During volatile periods, it's easy to make poor decisions based on momentum rather than value. I develop specific valuation frameworks before crashes occur when thinking is clear. Third, understand the difference between healthy volatility and destructive volatility. Healthy volatility occurs when prices fluctuate around reasonable intrinsic value estimates. Destructive volatility occurs during panic when prices become completely disconnected from reality due to forced selling and psychological breakdown. During Black Monday 1987, markets fell 22% in a single day with no fundamental news. This was pure destructive volatility, panic feeding on itself. I was positioned for increased volatility and could take advantage of extreme mispricings. The psychological secret is reframing your perspective. Instead of viewing volatile periods as threats, see them as accelerated opportunities to acquire valuable assets at prices impossible during normal conditions. Here's practical implementation. Maintain substantial cash during low volatility periods. Develop systematic approaches to volatility measurement. Practice dollar cost averaging during volatile periods rather than trying to time exact bottoms. Maintain longer time horizons as volatility tends to mean revert over time. Strategy number 3. Apply reflexivity to predict crash dynamics. The most powerful analytical framework I've developed for understanding market crashes is the theory of reflexivity. This explains why markets don't simply reflect reality. They actively participate in shaping reality through feedback loops that create self-reinforcing boom and bust cycles. Understanding reflexivity is crucial because it helps you recognize when conditions are becoming unsustainable and how crashes will unfold. Most investors miss these patterns because they assume markets are passive mirrors reflecting external economic conditions. But markets are active participants that influence the very conditions they are supposedly reflecting. Let me explain through the late 1980s Japanese asset bubble. Japanese stock and real estate prices had been rising for years, initially driven by legitimate economic growth. But as prices rose, they began creating their own justification for further increases. Rising asset prices made Japanese corporations appear more valuable, making it easier to access credit and expand operations. Expanded operations led to higher earnings, which justified higher stock prices. Higher stock prices increased corporate wealth, enabling more aggressive expansion. Meanwhile, rising real estate prices made property owners feel wealthy, leading to increased consumer spending. Increased spending boosted corporate revenues, supporting higher stock prices. Banks used rising real estate values as collateral for more lending, pumping more money into markets. This wasn't rational price discovery. This was a reflexive bubble where rising prices created conditions that temporarily justified even higher prices. The market wasn't reflecting Japanese economic reality. It was creating an artificial reality that could only exist as long as prices continued rising. I recognized this was unsustainable and positioned for collapse. When the bubble burst in 1989 to 1990, it triggered a reflexive crash where falling prices created conditions that justified even lower prices. The same feedback loops that drove the boom operated in reverse during the bust. The 2008 financial crisis provided another dramatic example. Rising housing prices created a reflexive bubble where higher prices justified more lending, which enabled more purchases, which drove prices higher. Financial institutions developed complex instruments to profit from this trend, creating a massive interconnected system dependent on continuously rising real estate values. When housing prices began falling, The reflexive dynamic reversed devastatingly. Falling prices triggered margin calls and forced selling. Lower prices reduced mortgage-backed securities values, damaging bank capital. Reduced lending made it harder for buyers to purchase homes, driving prices lower. Understanding reflexivity allowed me to recognize that 2008 would be more severe and longer lasting than most anticipated. The interconnected nature meant declining asset prices would create conditions for further declines through multiple feedback loops. Here's how to apply reflexivity. First, learn to recognize reflexive booms before they become unsustainable. Look for situations where rising asset prices are creating artificial conditions that temporarily justify higher prices. This often involves increasing leverage, relaxed lending standards, and widespread speculation. Second, understand that reflexive crashes tend to overshoot on the downside just as booms overshoot upward. When the feedback loops reverse, assets often fall well below intrinsic value, creating extraordinary buying opportunities for patient investors. Third, pay attention to specific mechanisms through which reflexive dynamics operate. In credit markets, it operates through collateral values and lending standards. In equity markets, through valuation multiples and access to capital. Understanding these mechanisms helps anticipate how crashes will unfold. Fourth, recognize that reflexive patterns operate on multiple timescales. The key is identifying which timescale is most relevant for your investment horizon and positioning accordingly. Strategy number 4, position against consensus at extremes. One of the most counterintuitive but profitable strategies is learning to position against prevailing consensus precisely when that consensus appears most certain, and going against it feels most uncomfortable. The greatest crash opportunities emerge when conventional wisdom is most entrenched and most wrong. I discovered this principle during the 1992 European exchange rate mechanism crisis, but it applies equally to market crashes. The key insight is that crashes occur precisely when consensus opinion has become so uniform that it no longer accurately reflects reality. During late-stage bull markets, consensus typically holds that economic growth will continue indefinitely, that asset prices reflect fair value, and that any declines will be temporary and shallow. This consensus becomes self-reinforcing as more people adopt similar positions and viewpoints, but extreme consensus creates its own vulnerabilities. When everyone believes the same thing and positions similarly, markets become fragile and prone to sudden reversals. Small changes can trigger large movements because there's no diversity of opinion to provide stability. During the dot-com bubble, consensus held that internet technology would revolutionize business permanently, that traditional valuation metrics were obsolete, and that internet stocks would continue appreciating indefinitely. This wasn't just popular opinion, it was professional consensus shared by analysts, fund managers, and institutions. I recognized that this extreme consensus had created dangerous fragility. When everyone believes the same thing and owns similar assets, any crack in the narrative can trigger massive selling as investors rush for exits simultaneously. I began positioning against technology stocks in 1999, well before the bubble peaked, because extreme consensus had made the market vulnerable to sudden reversal. This felt uncomfortable because I was going against professional expertise and apparent market evidence. The psychological challenge of positioning against consensus is enormous. Humans are social animals with deep programming to conform to group behavior. Going against strongly held beliefs triggers powerful discomfort and social pressure. During the housing bubble, consensus held that real estate prices would continue rising due to demographic trends and limited supply. Anyone suggesting significant declines was dismissed as pessimistic, I began positioning for housing collapse in 2005 to 2006, despite widespread professional opinion that such outcomes were impossible. The key to successful contrarian positioning is distinguishing between healthy consensus based on sound analysis and dangerous consensus based on groupthink. Healthy consensus emerges when diverse participants independently reach similar conclusions. Dangerous consensus emerges when participants simply adopt prevailing opinions without independent analysis. Here's practical implementation. First, develop systematic methods for measuring consensus, opinion, and sentiment. Track investor surveys, positioning data from futures markets, and media commentary ratios. Extreme readings often signal contrarian opportunities. Second, distinguish between your analysis and your positioning. You might recognize consensus is wrong, but timing requires patience and risk management. Position gradually rather than all at once, and be prepared to add to positions if consensus persists longer than logic suggests. Third, prepare psychologically for the discomfort. Going against consensus feels wrong by definition because consensus represents what most people believe. Having confidence in your analytical process and risk management is crucial for maintaining contrarian positions through difficult periods. Strategy number 5. Structure asymmetric risk-reward positions. The final and most crucial strategy is learning to structure positions where your potential losses are limited and known, but your potential gains are unlimited or substantially larger than potential losses. This asymmetric approach allows you to be wrong about timing while still generating substantial profits when crashes occur. Traditional approaches focus on being right about direction, timing, and magnitude. If you're wrong about any factor, you lose money. But asymmetric positioning allows you to profit as long as you're eventually right about direction, even with imperfect timing. I learned this during currency speculation, particularly the 1992 attack on the British pound. My analysis suggested the pound's exchange rate was unsustainable, but I couldn't predict exactly when crisis would occur or how severe it would be. Instead of trying to time the collapse perfectly, I structured asymmetric positions where my maximum loss was limited to the amount the British government was willing to spend defending the exchange rate, but my potential gain was unlimited because there was no floor to how far the pound could fall once defense was abandoned. This asymmetric structure meant that even if I was wrong about timing, my carrying costs were manageable. When crisis finally occurred, the asymmetric payoff generated enormous profits because the currency moved much further than most anticipated. The same principle applies to crash investing in equity markets. Instead of trying to predict exactly when crashes will occur, you can structure asymmetric positions that benefit from crash scenarios while limiting losses if crashes don't occur or take longer than expected. During the dot-com buildup, I used put options and short positions to create asymmetric exposure to technology market declines. If I was wrong and stocks continued rising, losses were limited to premiums and carrying costs. If I was right about eventual crash, gains would be substantial as overvalued companies fell to realistic levels. The key is understanding specific risk-reward characteristics of different instruments and market conditions. Options naturally provide asymmetric payoffs because maximum loss is limited to premium paid, but potential gain can be many times that premium if the underlying asset moves significantly in your favor. During volatile crash periods, implied volatility often understates realized volatility, making options relatively inexpensive compared to actual price movements that occur. This creates opportunities to structure highly asymmetric positions at attractive costs. But asymmetric positioning extends beyond options to fundamental security selection. During 2008, high-quality companies with strong balance sheets fell to prices implying very pessimistic scenarios. Purchasing these at distressed prices created asymmetric opportunities because downside was limited while upside was substantial. Here's practical implementation. First, learn to use options appropriately to create leveraged exposure to crash scenarios. Put options on overvalued indices can provide substantial asymmetric exposure at relatively low cost during low implied volatility periods. Second, focus on security selection that naturally provides asymmetric characteristics. Look for high-quality companies trading at prices implying very pessimistic scenarios. If those scenarios prove correct, losses will be limited. If conditions improve, gains will be substantial. Third, manage position sizing to optimize asymmetric payoffs. Rather than making large bets on specific outcomes, make smaller bets on multiple asymmetric opportunities. This diversifies exposure while maintaining favorable risk-reward characteristics. Fourth, understand the time dimension. Some asymmetric opportunities are time-sensitive. Others can be maintained for extended periods. Match your positioning to your ability to maintain exposure through uncertain time frames. The foundation of crash mastery. These 5 strategies: probabilistic thinking, embracing volatility, applying reflexivity, positioning against consensus, and structuring asymmetric risk-reward, form a complete framework for not just surviving market crashes but profiting enormously from them. The reason most investors lose money during crashes isn't lack of intelligence or information. It's that they approach crashes with the wrong mindset and the wrong strategies. They try to predict unpredictable events. They fear volatility instead of embracing it. They follow consensus instead of thinking independently. They structure symmetric bets requiring perfect timing instead of symmetric positions allowing for uncertainty. Market crashes will continue occurring as long as human psychology drives financial markets. The specific triggers will change, but underlying dynamics of boom, bubble, and bust will persist because they're rooted in fundamental aspects of human nature that remain constant across different eras and economic systems. The question isn't whether you'll experience crashes during your investing lifetime. You will. The question is whether you'll be prepared to recognize the opportunities they create and position to profit while others lose wealth. In 2008, when the global financial system was collapsing, I made over $1 billion because I had prepared for exactly these conditions. Not because I could predict specific timing or exact events, but because I understood the principles that govern how crashes develop and how to position asymmetrically for them. These same principles are available to any investor willing to study market psychology seriously, develop contrarian thinking capabilities, and maintain the discipline to position against conventional wisdom during extremes. The opportunities are there, the patterns are predictable. The next major market crash is mathematically inevitable. It might occur next year, it might develop over 5 years, but it will happen because crashes are inherent features of market cycles driven by human psychology. When it arrives, will you be among the prepared few who profit systematically from the chaos, or among the unprepared many who lose their wealth to those who understand these principles? The choice is yours, but making the right choice requires beginning preparation now, before the crisis arrives and emotions control decisions. Because, as I learned over 60 years of investing, market crashes don't destroy wealth. They simply transfer it from those who are unprepared to those who understand how the game is really played.